guys, and welcome to yet another video. So in the previous videos we have been looking at some of the information concerning the forex market. So in our outline in the previous videos we have looked at what is forex, some kind of introduction about forex. We have also gone ahead to look at what is traded in forex. We have broken down to currency pairs, major currency pairs, minor currency pairs, and we have looked at all that information, and the video is in right here in this channel. So you're going to be looking at those videos. If it is your first time to come in this channel, make sure that you look to the previous videos and you're going to find that information. So we are now going to look at what or who is a forex broker. So that is where we are standing at right now. So that is where we are going to be beginning our lesson from. So, and before we can begin our class today, I want to tell you that when you get this document, I'm going to be dropping it in the Telegram channel and also in the WhatsApp group. So if you get this document, you can click on this link and it's going to navigate you directly to our channel here. Make sure that you subscribe, and when you come to this playlist here, you're going to be finding all the videos related to forex trading beginners course here. So you can also have you can check out other videos concerning crypto airdrops and more crypto exchanges, crypto wallets, and more. So if you want also other links related to our channel, you can always click here, and it's going to navigate you to the list of links to the Facebook page, the X account, and more. So right back into our topic of today is that who are forex brokers, or what are forex brokers? Like I had told you earlier in some of the introductory part of our videos, a forex broker is a financial institution or company that facilitates the buying and selling of currencies. So these people or this institution will help you gain contact with the forex market. They will facilitate you with accounts that will help you gain access to the forex market. So you can see I've arranged some information also in this document, and you're going to be going through. I'm not going to be reading through every statement written here. I'm just going to be explaining through, and you're going to be understanding, and you can also watch the video as you also read this document, and I'm going to be dropping it in the channel of the Telegram channel in the WhatsApp group. So let's continue. So I hope you've understood what I've said, that forex brokers are just institutions that will help you gain access to the forex market, because as an individual you cannot be able to gain access to the forex market on your own. So it is very important to have an account with a forex broker. So they are mainly categorized into two. So there is the A book brokers and the B book brokers. So there is also the hybrid brokers. I'm going to be explaining what they are. So A book brokers, these brokers are also known as direct market access, because they will execute your trades directly into the interbank market, or they are going to take your trades directly to the market, contrary to what the B book brokers will do. So some of the points to note here is that they will pass trades to the liquidity providers, meaning they do not take the other side of the trade like the B book brokers. So this model is your result to more transparency and pricing, as traders can benefit from real market spread. So as maybe you're going to learn, brokers normally benefit from what you call as spreads and commission, and in our case here, the AB brokers will mostly benefit from the spreads, and we are going to be seeing what are spreads in the upcoming videos, or even in this video I'm going to touch on what are spreads. So A-book brokers typically charge commissions. You can see they also charge commissions and markups. So on the spread instead of pressing trades against their clients. That is one of the advantages of the A-book brokers. So when we go ahead to look at what a B-book brokers is, B-book brokers are on the other hand will not pass all trades to the interbank market. Instead, they may take the opposite side of a trade. So this means if a trader bets or analyzes the market and takes a trade in a certain currency pair to rise, the B-book brokers will profit if the trade loses. Let's take an example. If you take a trade and you want to take a buy on a certain trade, the B-book brokers, maybe they know you have been losing consistently, so they are going to take a trade against you as a trader. So whenever you lose that trade, they're going to be benefiting not only maybe from the commissions and the spreads, but also the whole amount. If you lose, you're going to be losing to them. But it is good also to note at this point, it doesn't matter whether you're using an A-book broker or a B-book broker, because even them as the B-book brokers, they can also lose trades to you as a trader. If they take trade against you, and in that instance it does not go to a loss and it wins, it means that they are also losing money to the trader. So it is very important to note that. So moving on is that this means that, okay, going ahead, and B-book brokers can also offer tighter spread, as may provide additional incentives and promotions. So they offer maybe favorable spreads as compared to maybe like A-book brokers, because they also benefit from taking trades against maybe their clients, because unlike the A-book brokers, they may be having some wider spreads, as we are going to be looking what are spreads in the coming video, I'm going also to explain briefly what is spread also in this video. So keep watching and let's continue. So you can see that B-book brokers will take against trades, trades against the traders, and the A-book brokers will directly take your orders to the interbank market. Okay, and also it's very good to know that there are also brokers that will intermarry the two, or we have the two models, and they will analyze. They will have some kind of software that will analyze the metrics of the way traders have been trading. They will understand and know the profitable traders and the losing traders. So if you have been losing consistently, the hybrid traders will take will not take your trades to the interbank market. However, they'll take trades against you. But if you're in profitable trader, they are going to be trading. They are going to be taking the orders directly to the interbank market. So it is very good to note that as we continue. So, however, there may be some potential conflicts of interest, as the brokers might benefit when a trader loses, as I have told you. So I've told you I'm not going to be leading through all the information here. I'm just going to be guiding you and expounding for you to understand. So even before we can continue, there's some of the brokers that I've recommended, or maybe the brokers that I have been using. Some of them have embedded some of the links in this document. So in the footer of the document, you're going to find the link to these brokers. So you just have to click on these links, and it's going to navigate you directly to the websites of these specific brokers, and you can go ahead and open an account on these brokers. You can choose one for you, the one that suits you best, or the one that you find good for you. But it's good to open 4 of them and also compare. I have also accounts in all of them. So I'm also going to be making a video explaining to you or showing you step by step on how you can open a forex trading account in these brokers. So let's continue. So okay, in summary, the difference lies in how the brokers handle trades. As I've told you, their profit models. A-book brokers focus on executing trades in the market, while B-book brokers often manage trades internally. As I have told you, they may have some softwares that analyze the metrics of traders. So there is also what we call as hybrid brokers. I've also explained the two hybrid brokers. They blend both the A-book brokers and the B-book brokerage models. They utilize aspects of both systems to provide flexibility and cater to different trading needs, as I have told you. So some of the breakdown of the hybrid brokers, which I found that most of brokers maybe are hybrid, so that they can be able to have flexibility in catering for different trading needs. So number one, they have flexibility. Hybrid brokers can choose to execute some of the trades in the interbank market, that is A-book brokers, while managing others internally. That I have told you, they have softwares to understand the behavior or the profitability, or according to the metrics of how traders are. They are going to understand if a broker, traders are profitable or they are not. They're going to know whether they're going to execute the trade, or they're going to trade against you internally. So this allows them to recognize their options and manage risk effectively. So client segmentation, they may categorize clients based on their trading behavior. As I've told you, for example, high volume or professional traders might have their trades sent to the interbank markets, while retail traders might have their trades managed internally. So I have also told you that. So competitive pricing, by combining both model hybrid, they may have a competitive spread, as I have told you, compared to the A-book brokers. They can leverage the benefits of both A-book and A-book and B-book. So they benefit from both systems, as I have told you. So number 4 is the risk management. Hybrid brokers can manage their risk exposure more effectively by balancing trades between A-book and B-book. They can mitigate potential losses from clients' trades when still offering favorable conditions. So those are some of the maybe advantages of hybrid brokers. So in instance, hybrid brokers aim to provide a volatile trading environment that appeal to various types of traders. So very, very, very important to note that. So I have also written some of the advantages and the disadvantages here, so that you can understand in detail about these brokers. So number one of the A-book brokers is that they have transparency. We have talked about that, because you're sending your orders directly to the interbank. Fair execution, since they don't take the other side of your trades. Better pricing, yes, we have also talked about that. And the regulatory compliance, A-book brokers tend to adhere to strict regulatory standard, offering higher level of security. But as I've told you, some of the A-book brokers, they combine, some of the brokers also combine the two models. So they also have regulatory compliance, which you are not supposed to worry about. So some of the disadvantages, high cost. I have told you that A-book brokers may have wider spreads as compared to B-book brokers. So, and also the slippage. So due to market conditions, trades may experience slippage during volatile periods. So slippage is what is known as when you execute a trade, before it gets executed, the market is so volatile. Maybe sometimes the market is so volatile. Before the order is executed, the price may have moved to where you wanted it to be executed and to another to a distance away. So this is what is known as slippage. Trading experience slippage during volatile periods leading to execution at different price than expected. So you can expect to execute at a certain level, but because of price movement and the volatility of the market, the slippage can affect you. So for you to manage this, you can also use what is known as limit orders. I'm also going to be talking of what are limit orders in the upcoming videos. So make sure that you keep it locked in this channel. There's much and more that I need or I have to share with you. So big book brokers and their advantages, they have tighter spreads. So as I have told you, they may have some good spreads as compared to the big book brokers. So or the e-book brokers, because they have they are benefiting the trade against you. So big book brokers can offer tighter spread and no commissions, making them attractive for retail traders. So most of the retail traders will love to have accounts with these brokers because they have good spreads, and maybe no commission. So another is because of incentives and promotion. They may also offer bonuses, promotion, and incentives to attract traders, which means they enhance trading conditions, simplicity. The trading environment may feel simpler for beginners, and they often deal with one broker without direct market complexity. So very important to note that. But some of their disadvantages is because they have conflict of interest, because people brokers may have conflict of interest when they take trade against you and you lose. Those losing trades, they're benefiting from those trades, which can seem to be a concern and maybe look like unfair treatment. So that is what you should understand about that. Less transparency. The lack of direct market execution leads to less transparency, pricing, and potential manipulation of spreads. So you may find some of the manipulation here and there to the B-book brokers. So, but most of the brokers, and some of which I've shared with you here, they are models. They have both models, so you have nothing to fear about. So it's very important to note that. So there is also risk exposure. So big-book brokers take on more risk and may limit certain trading strategies. So this is because they're taking trades against you, so they may restrict certain things, but this will not make you not to make profit. So if you have a working strategy, you have nothing to worry about this. So these are just some of the things to note. In summary, e-book brokers are generally seen as more transparent than the b-book brokers, as I've told you. So I've also told you that most of them will have both models, which is also good. So again, I have told you I'm going to be talking about the commission and spread. So in forex trading, typically charges from these brokers, they are in terms of spread and commissions. So commissions, this is a fee charged by a broker for executing a trade, and maybe they fix something like sometimes trading volume, trading percentage. So commission can be fixed amount per trade or per percentage of the trade value. So I'm going to be talking in detail about that in the upcoming video. So when you execute a trade, commission may be deducted from your account balance. As soon as you execute the trade, the commission automatically is deducted to your account. It's good to note that in accordance with the terms, maybe the trading volume, the lot size, and other things in there. So some brokers may offer commission-free trading, but compensate wider through spread. So again, some brokers, or most of the brokers, will have spread. Spread is what is referred to as the difference between buying price, which is ask price, and the selling price, which is the bid price. I'm going to be explaining in detail in the upcoming video, but it's good to know that spread is the difference between the ask price and the bid price. It represents the cost of trading varied based on market conditions, liquidity, and the broker's pricing model. So when the market maybe is volatile, the spread may be smaller as compared to when the market is not moving a lot. When the market is not volatile, the spread may be wider. So for example, if the Euro USD pair has an ask price of 1:1, 1200, and the bid price is 1:1180, the spread will be 20. Very important to know that. I'm going to teach you about it in the upcoming videos. So this one was just to let you know what spread and commissions are, and just to touch a little bit of it. So when commissions are direct fees charged for trading, spreads represent indirect cost for entering and exiting trade. So as you're going to find out, spread will not be automatically deducted from your trading balance, but they are going to be charged indirectly as the gap that you have seen between the bid price and the ask price. So we are going to be seeing that in the upcoming videos, not something complicated. So we have come to the end of our lesson today. So I hope you have understood something very important concerning brokers, book brokers, b-book brokers, hybrid brokers, and some of their advantage and their disadvantages. So as I have told you, you can go ahead to the footer of this document, and you're going to find some of the brokers that I use here, and you can go ahead and open an account using any of them, or even you can open using all of them, because some of them will offer different assets for trading. Like Deriv will have things like synthetic indices, which are not found in other brokers. So it's very important also because they also have different leverages. We're also going to look at what leverage is, which is very important when it comes to trading. So guys, I hope you have understood in detail some of the things you need to understand about the brokers, and I'm gonna help to explain everything for you in a very simple way. So make sure that you subscribe to this channel, share this video, like and subscribe. Before I let you go, it's good to help you know how you can be able to identify whether the broker you're using is a book broker, B-book broker, or a hybrid broker. So you're going to be heading over to this website known as the brokersam.com, and then you're going to be navigating up here, and then you're going to come where it's written as brokers. Then you're going to be finding out whether your broker is a big brokers. You can click on a big brokers, and it's going to open a page here, and you can search, or maybe you can click on B-book brokers, and you're going to search here, or whether it's a hybrid broker, and you're going to be having some kind of page like this, and you can enter the name of your broker here, and you're going to find out whether it's a B-book broker, a book broker, or a hybrid broker. So I hope you've understood everything, guys. So let's meet in the next one. Bye bye.